Hello everybody, welcome to another episode of Erickson TV. Hello Lauren.
Hey Curtis, hey everybody.
Alright Lauren, so I've talked about this SigFig before, which is it's a nationwide service that tracks investors' investing activities. Okay. So they have so they're tracking 500,000 investors nationwide with total assets of $200 billion.
That's a lot of assets.
Significant. Okay.
Right.
And so the nice thing about this is you can actually kind of see historically what these people are doing with their investing.
Right.
Okay. And so the interesting thing was that they're talking about the 2014 year alone, okay,
right,
of investing, and what they looked at is they tracked the investors that have the highest amount of turnover in the portfolio.
Oh, okay.
So these are all. So they tracked the investors with what they call high turnover, and this means that they turn their portfolios at least 100% or greater.
Oh, okay.
That makes
Right.
sense. Very similar to an active mutual fund.
Right, yeah.
And what they found is that the investors that had 100% turnover or greater for the year 2014 had more than 6 times the losses of the buy and hold investors.
Ooh.
So what's your takeaway from that?
That's not particularly surprising.
Yeah.
I think they probably were chasing whatever was hot in 2013, and it probably didn't work out so well in 2014.
Yeah, no, it's interesting. Yeah, so the 6-month average return for these aggressive, they call them the aggressive investors,
Right. Okay.
had negative 7% per year of performance.
Wow.
Interestingly enough, though, the 6-month performance for the active, which is 11 to 50% turnover, was a negative 5% return.
Okay.
And then the buy and hold with less than 10% did a negative 1.42%. So pretty significant difference.
Yeah, that is a big difference.
So the takeaway, I guess, is even in the relatively short term, it's not always productive to be an investor that turns over their portfolio a lot. Yeah.
Right, and I think it suggests that most people who turn over their portfolio a lot really don't have a good sound strategy for why they're doing
Right.
it. They really, truly are just reacting on emotion.
And perhaps chasing hot asset classes.
Yeah, and chasing on asset classes. Because honestly, if people just had a strategy, the differences shouldn't be that big.
Right.
I mean, they should be getting a lower return maybe because of trading costs, because we're just dealing with averages.
Right.
So some would do a little bit better than average, and some will do a little worse than average. But whenever you look at these studies, it looks like most people, most people, are doing worse than average.
Right.
Which suggests that they just don't have a strategy.
Right,
They're
yeah.
kind of emotionally jumping around from things. And
Right.
it's like leading them to do the worst things they could realistically do.
So the takeaway from this article is if you do not have a strategy, please contact
That's right.
Lauren and myself, and we'll help you develop a strategy.
Yes, absolutely.
All right. Thank you for watching this episode of Erickson TV. Bye now.
Bye-bye.